mortgage side of the transaction, and I've been doing that now for 23 years. And there's a lot of information you all need to know. It's good to know like a little bit about homeowners insurance, a little bit about the title company and how their process works and what they do for the part of the transaction. It's good to know like some for the mortgage side of things as well too. So when you're talking with your potential clients, you have an idea of what type of programs are out there for them. So you just know it like enough to be dangerous, so to speak. Is everybody on the call, are you all brand new to real estate in general, or just brand new to real estate like in like our Tampa Bay area?
I am new in Florida here, but I came from New York.
Okay, and you did real estate up there?
Yes.
Okay, and I've never originated a loan in New York, but from what I've heard, the transactions do take longer to go through.
Yeah, 45 to 60 days sometime.
Okay. And down here I've closed some in 8 days. So now it certainly can't guarantee that all the time, but we do have the ability to close quickly. Like at our company, we're a direct lender, just like a bank, like direct FHA for VA, conventional loans, USDA loans. We're a direct lender with all that, so we can process the loans, underwrite the loans, fund the loans, and we do service some loans as well too. So that's nice having that ability to turn things around quick. Because some of y'all, like there'll be multiple bids coming in on a contract on a home that's listed for sale, and you'll need to come in like with your highest and best offer, and the seller wants you to close fast. So it's nice to have that option here in Florida that you can close in less than 30 days. And it's becoming a little more common now. I've over the last couple weeks, I've heard of there being multiple bids on the same houses, where it was like that, back when interest rates were super low back in 2021, 2020, the first part of 2022, it was super competitive. And it's been over the last couple of years now, like it's been easier for buyers to get their offers accepted, which is really nice. But I have, the business has picked up and there has been multiple bids lately. So, having your buyer, pre-approved from the get-go, before you're taking them out, like looking at houses is going to be key. So you're not like wasting like a lot of your time, showing them houses if they can't qualify. And a good friend of mine, back when I first got into mortgage industry, he was in the real estate side of things. He'd always have buyers that are trying to make them go out and look at houses, and he'd always put it on the lender. Hey, listen, or the seller. Hey, listen, you're going to need a pre-approval letter to get into this house. Like, the sellers, cleaning the house, packing up their stuff, like, getting their kids out of the house so you can go into it. So you can put it on the seller. They need a pre-approval letter. And then, finding a trusted lender that can do a good job on the making sure like the I's are dotted, T's are crossed, so you're not putting people in your car that can't qualify to buy. Because any lender can give a pre-approval letter to somebody, but that doesn't mean that the transaction can actually close. So I could give somebody a pre-approval letter to go out and look at houses, and they could have a 450 credit score. So some lenders just shotgun pre-approvals out, without doing their due diligence, without, maybe pulling credit, without running the computer generated underwriting approval. Those are, key things, before you're taking somebody out. You want to make sure, that the lender took a look at their credit, that, they, figured out like what their income was, what their debt to income ratio is, and making sure they're running it through our computer generated underwriting approval. You know, Generally, like for us to do a pre-approval for somebody, you can get us their name, phone number, email address, and then you can connect them like with us. Like a joint text works great, to introduce like the lender to them, and introduce them to the lender. All right. So this just shares a little bit of who we are. Like we're a direct like FHA, Fannie Mae, Ginnie Mae. So Ginnie Mae, that's who governs FHA loans, VA loans. VA loans are for veterans, people in the military. Who's it? FHA generally is going to be more directed, like not directed. More of your first time home buyers would be doing FHA loans. It doesn't have to be a first time home buyer to do FHA. Somebody with not quite as good of credit is going to do an FHA loan. Um, our FHA loan program, ideally having over a 580 credit score is ideal for our FHA loan. We can actually go down to a 500 credit score on our FHA program and on our VA program. VAs for people that are in the military, active duty, or retired. That's a 100% financing product. FHA does a down payment of 3.5%. Conventional loans, which that's governed by Fannie Mae and Freddie Mac. Those are government-sponsored entities. Conventional loans require a minimum of 3% down if they have not owned a home in the last 3 years, and 5% down if they have owned a home in the last 3 years. So FHA loans, VA loans, they're for primary residence buyers only. You can't do that for if you're buying a second home or like a vacation home or an investment property. If you're buying a second home or an investment property, you're going to be doing conventional financing, or we do have like portfolio programs, but which we'll just talk conventional financing for right now. Doing a second home purchase or a vacation home, that's a minimum down payment of 10%. Doing an investment property purchase where you're going to be like a long-term renter in there, that's a minimum of a down payment of 15 to 20%. Generally, your rate pricing is going to be much better if it's a non-owner occupied home, being a second home or an investment property with 20% or more down. FHA, again, it's a minimum of 3.5% down and that's of the purchase price. And that's based on having a 580 credit score or higher. If they have under a 580 credit score on an FHA loan, they have to do a minimum down payment of 10% of the purchase price. If it's under a 580 credit score. For VA, technically we can do zero down payment down to a 500 credit score. That doesn't mean everybody gets approved down to a 500 credit score. So ideally over a 580 credit score is ideal. If somebody is trying to do a down payment assistance program, now a number of you, like would you all being like new or maybe newer to the area, or brand new to the business, maybe depending on your age that you are, like your initial, buyers initially maybe first time home buyers. We do have down payment assistance programs available. The state of Florida down payment assistance program is the easiest one to get per se. That requires a 640 credit score. And that's a state-backed down payment assistance program, and their requirement is a 640 credit score. We do have some down payment assistance programs that go down to a 600 credit score. We don't use them a heck of a lot though, because the interest rates generally are going to be higher. The closing costs are higher on that. So the state of Florida down payment assistance program typically is going to be your best one, in my opinion. And they never run out of funds either for the regular state-backed program. There are like city programs and county programs, which you may hear of some of those, like in the city of Tampa, or like Pasco County has a program, Pinellas County has a program. Those are not always going to have funds, and they're a little bit more difficult to get qualified for as well too. We do underwrite all our own files in-house, which that is awesome because, I've been doing this 23 years, closed thousands of loans, and I still have clients to call in with different scenarios that I have to run by my underwriter or my underwriting manager. And like, I'll call them and I'll be like, I cannot believe I'm calling you again. I cannot believe I'm calling you again, just because there's just so many different scenarios. So that's why it is okay for you all not to know everything. You never will know everything. And it's okay, like to say, hey, listen, let me double check with my trusted lender partner or my trusted title partner or my trusted, homeowners insurance partner. Finding like a good representative, like for each one of those industries, finding a good loan officer, lending partner, homeowners insurance agent that you can call and just run the scenarios by. I had a homeowners insurance question yesterday that I called an agent, a client of mine. They're buying a house, and they have a house that they currently own, and they have an open insurance claim on the house that they're going to be selling. Well, I needed to make sure they're not going to have any issues they're selling that house, and the insurance claim probably won't be settled prior to closing. So I needed to make sure that the buyer of their property is going to be able to get homeowners insurance. I needed to make sure that this seller with an open insurance claim would be able to get homeowners insurance on the property they're buying. and like I called the insurance agent and he found some options. You'll have different questions like with title work, or title, like if they're trying to close under the name of an LLC. So people that have investment properties, they may want to title a home in an LLC. Well, you may need to ask some questions to the title company, and to the lender. Hey, by the way, is this okay for my buyer to purchase a home under an LLC? And if it's an investment property through our portfolio programs, we can do that. So you don't need to know everything, and just try to find, again, a trusted resource in each one of those industries so you can get your questions answered on your transactions. The pre-approval process in general, like we can get done, roughly, I tell people, 15, 20, 30, 40 minutes or so. Sometimes it takes an hour, just depending on how detailed somebody's file is. Like if they've had, 5 different employers over the last 2 years, that's going to take us a little longer to input the information. If they've like, lived at, 3 or 4 different addresses. So we have to get typically a 2-year work history, a 2-year residency history where they lived. We're going to get uh, we're going to pull their credit. One thing that we do different now than we did in years past is we can do a soft credit inquiry on your clients up front, which really puts the clients at ease, because like people always get worried, oh, I'm going to get my credit pulled and it's going to hurt my credit score. Well, now we can do a soft credit pull. It still gives us the exact same credit scores that a hard credit pull would do, and we can still like run our computer generated underwriting approval. Now, we do have to do a regular credit pull prior to closing on the loan, but we can wait to do that until they're actually under contract. So we're not putting more dings on their credit than necessary. The credit reports, when we do the hard pull, are good for 120 days. So if as long as they're closing within the 120-day mark after pulling that hard credit pull, we don't have to pull it again. The documents that we're typically asking for are over here on the right. I always say 22222. 2 most recent pay stubs, 2 most recent bank statements, 2 most recent W-2s, and 2 most recent tax returns in general. 22222. So the 2 pay stubs would be from this year, the 2 years of W-2s, that'd be from the last 2 years, and that's what they get at the end of the year from their employer. And then the last 2 tax returns and the last 2 bank statements. Now, the 2 tax returns aren't always absolutely necessary if they're not self-employed, or they don't have rental income coming in. But like for our down payment assistance program, the state of Florida actually requires us to collect 3 years of tax returns for that program. After I get like their employment information, their income information, I pull their credit in, I see what's called their debt to income ratio, and that's what they're spending of their monthly income on their house payment in comparison with the bills on their credit report. If all those numbers match up and I get my computer generated underwriting approval, I'll go ahead and I'll send out the pre-approval letter. Now, the documents being their pay stubs, tax returns, W-2s, I will issue a pre-approval letter without having those on hand if the buyer is on like a salary. Let's say they're and they make 60,000 a year and their spouse works at T. Rowe Price, and they make $60,000 a year. I'll issue that based off of what they're telling me that their income is. Where if they're self-employed, almost all the time before I issue a pre-approval letter, we'll want to get their tax returns first because it's not as straightforward as they might be writing off a number of expenses, and then we have to factor that in as far as their income qualifying. Does anybody have any questions so far, or anything they want to give input on, or feel free to ask. Okay. Here's what the pre-approval letter looks like. I will send this out to the buyer and to the buyer's agent. And then this will, if they're putting an offer on a house, I'll put like the address of the property. Sometimes the agent will want me to put the purchase price that they're offering for the home. Sometimes they'll want me to put the list price for the home. Generally, I'll put it at what the list price is, just so like then the seller knows that they're covered. That doesn't mean that what you have to offer. The loan amount is going to be the difference of the purchase price and the loan amount. That's their down payment. Um, Buyers again can do 3% down if on a conventional loan if they haven't owned a home in the last 3 years, 5% if they have. And then on here, I'll put in here if the property type, if it's detached, single family home, condo, townhome. You want to make sure, like if the buyer's looking at condos, to let the lender know that, because there's stricter guidelines on condos than there are on a single family home and a townhome. There's extra documents you're going to need to collect. Not necessarily the agent, but um, we have to get like the condo documents, the project's master insurance policy, a long condo questionnaire, a copy of the budget for the community. So there's just more that goes into that type of transaction. So you want to make sure you're communicating with the lender, with the type of properties that the person's looking at. And we become a team, the buyer's agent and the lender. We work together as a team. What I'll typically do after I pre-approve somebody, I'll send a pre-approval letter out to you all and the buyer. And then I'll also do a joint text to the buyer or buyers and the buyer's agent. So then we can communicate that way during the transaction. Like, you can say, hey, putting an offer on this property at this purchase price. Can you get us an updated pre-approval letter? Now, the pre-approval letter that I'll give you up front, I'll put it in Word format so you can match it up with any offers that you need to do. Like if you're doing it late night and you need to make an edit to the property address, or you need to change the purchase price slightly, I'll give you guys permission to do that. Now, if you're looking at condos or townhomes, a reason that's important to let the lender know is because then we're having to factor in a homeowners association fee or a condo fee into the monthly payment, and that can affect their debt to income ratio and their qualifications. I had went over like what the minimum credit score requirements are. So ideally, again, if you can have a credit score into 600s, if you're doing like an FHA loan, VA loan, but we can go under that. This discusses like what makes up a credit score. Having really somebody, all they need is one or two credit cards that are in good standing. They just have to keep a small balance on one of them to get good credit scores. You don't have to have a car loan and a mortgage and credit cards. You also don't have to have small balances on every single one of your credit cards. So I'll sometimes get clients' credit reports and I'll see they have like 20 credit cards with small balances on them. And I'm like, why do you have small balances on all these? They're like, well, we heard it's not good to have only have $0 owed on credit cards. I was like, you don't want to have $0 owed on all of your credit cards. Like you want to keep a small balance on one, but you do not need to keep a small balance on, 10 or 15 credit cards. If you do have open credit cards and you have them at a zero balance, make sure not to close those credit cards out. So sometimes people will close them out and that can hurt their credit scores. Now, if they do have them paid at a zero balance and they're not using them, make sure that they don't have an annual fee on that card. Because if they have an annual fee, I see people forgetting that they have an annual fee on a credit card. And then if they're not using the card, they won't realize that a balance is accrued when that annual fee hits, and then they'll get a 30-day late. So I always recommend with my clients, hey, get your credit card set up for the balance to be paid automatically out of the bank account every month. So then it's squared away. And if it has an annual fee, then when that kicks in, it'll automatically be paid out of their bank account. If somebody's brand new, like let's just say they're just getting out of college and they've never had a credit card before, generally it's going to take somebody 6 months of reporting their first liability on their credit report before they'll get a credit score. So if they've never had credit before in their life and they open up one credit card, generally that'll have to report for 6 months before they'll get a credit score. Credit Karma is a popular credit monitoring site. Your Credit Karma credit score is not what your mortgage FICO score is going to be. You're going to have different credit scores if you're pulling a credit report for a car loan compared to a mortgage, compared to a credit card. So Credit Karma is great for credit monitoring. but that's not going to give you your actual credit score for a mortgage. This talks about like what makes up a credit score, like delinquency. That's the biggest thing. If you have a 30-day late, that's crushing to your credit. And the more recent that 30-day late is, it's even more crushing. So the further away you can get away from those is ideal. Just because they had 30-day late in the last 12 months does not disqualify them from buying a house. Just because they have collections on their credit report doesn't disqualify them from buying a house. If they say that they need to work on their credit, nothing wrong with having them, like us, pre-qual them, set up a file. If their credit scores are not where they need to be right now, we can help them get their credit scores up sooner than later, so we can just at least set a game plan. Something that you want to encourage the buyer to do, they want to have a lender take a look at their situation before they're ready to buy. Because one example, when I bought my first house down here in Florida, second house, I had not had any, like I had one credit card that I used all the time. I had paid off my car. I had paid off my student loans. So this was about 12 years ago. I had one Grow Financial credit card. Well, when I pulled my credit, my one credit score, what was it, like a 739, and my other credit score was like a 679. So you have three credit scores: Equifax, Experian, TransUnion. Well, come to find out that the Grow Financial credit card was only reporting to one of the three credit repositories. It was only reporting to like Equifax, not Equifax, TransUnion, and Experian. Here I'm in the industry, and I didn't realize that it wasn't reporting to all three. Well, I took a look at everything prior to being ready to buy, and I saw that, and I was able to go into Grow Financial. I said, "Hey, by the way, you guys aren't reporting this to TransUnion and Experian." They ended up reporting it to TransUnion Experian. There, my credit score went up for all three scores up to like, whatever, 720, 730. So taking a look at these things ahead of time, I have people with perfect credit other than they had a medical collection that popped on their credit report that they weren't aware of. Or they had a Spectrum collection on their credit report they weren't aware of from equipment that they turned in that Spectrum didn't say that they turned in, and they did. Well, if you can take a look at that prior to them needing to buy, you can get ahead of that and you can try to take care of those things. There's ways for them to like offer pay for deletes to get collections deleted. Sometimes paying off a collection brings down the credit score. So ideally with a collection, you want to try to get them deleted. Any other questions from anybody else on any of the credit pre-approval part so far? Okay. One thing that you can encourage your clients to do once we do pre-approve them, encourage them to get us their income documents as soon as possible. Pay stubs, W-2s, so we can review it to make sure that the income that they told us that they make is actually what. Here at VanDyk Mortgage, we're also able, once we get all the income documents, we can get the client and the buyer's file underwritten while you all are out looking at houses. And then in addition to the pre-approval letter, we can give you a certificate showing that it's been underwritten. And that will help out with getting the buyer's offers accepted. And then for sure that they're good to go as well too. We kind of covered some of this already. What makes up a credit score, like the length of time they've had the credit account. Like, so the longer that you have a credit card, the better that helps the scores. The credit mix, like a mix of, credit card, mortgage, installment loans. But again, I've seen clients that have had two credit cards for, 24 months that have credit scores in the high 700s. So it's not absolutely required. You don't need to go out and take like a car loan to think it's going to help your credit if you already have like a couple credit cards. I do have, I've seen where parents have put like kids on their credit cards as an authorized user. Nothing wrong with that. That does give a younger person a credit score. Somebody's over 18, that will give them a credit score. However, you want to be careful like that they're not getting put on too many of those cards, because that can underwriting can look at that as kind of skewing their credit, that it isn't a true representation of the credit score. So getting put on like one credit card of their parents as an authorized user, that's okay. If they're doing that, you want to make sure that the client also gets like one credit card of their own. Um, I'm always in, favor of like, if like you're going out to eat, if you're not paying cash, which not a lot of people do that anymore, I would certainly recommend putting it on a credit card versus a debit card because I've had clients that have got their debit cards hacked and it ties up their money in their bank account. And it puts some people in financial binds where if somebody hacks your credit card, they're just going to cancel that credit card and issue a new one. So now you want to keep your credit card balances under control and, pay them off every month. That's just a little bit of advice on that. Defining credit score in today's market, anything over, so it goes up in tiers. So like anything over a 760 is great, great credit. 780 now is actually the top tier for conventional financing. Anything over a 720 credit score for FHA and VA loans is top tier. And then under those, it'll go in tiers. So like on a conventional loan, a 760 credit score compared to 780, the pricing is just going to be the closing cost pricing is going to be a little bit worse and higher for the same interest rate. Like a 720 compared to a 740, 720 is going to be a little bit worse. You also have what's called, if you're not putting 20% or more down on a conventional loan, you have mortgage insurance, or called PMI, private mortgage insurance. The higher the credit score on a conventional loan, the better, the lower your mortgage insurance premium is going to be. Mortgage insurance is super cheap these days. So like somebody's thinking that they have to save up 20% to buy a house for a down payment. That's definitely not needed. They can do as little as, again, 3 to 5% down, and the PMI is very inexpensive. If they have credit scores down into the 600s, generally that's going to probably be like an FHA buyer generally. If they're doing a conventional loan with a credit score in the mid 600s, more than likely it's going to be somebody that's putting a down payment of 20% or more than likely. If they said they have credit scores like under a 580, it doesn't mean that they can't buy. Let us, get them a game plan together to help get their credit in line sooner than later so they can buy sooner than later. Employment history, generally we want a 2-year employment history. If you have somebody that graduated college, let's say you have a teacher that graduated college or a nurse that just got out of nursing school and they've only been teaching or a nurse for a few months, we can use their schooling to complete the 2-year work history. So they don't absolutely have to have been with their current employer for 2 years. Somebody doesn't have to, so they don't have to be with their current employer for 2 years if they haven't graduated college and they've been with their current employer for 6 months. However, prior to that, they were with their previous employer for 2 years. Totally fine. As long as they're like a W-2'd borrower, and they're either paid full-time hourly or on a salary, it's fine if they haven't been with their current employer for 2 years. If they're a commissioned base employee, let's just say they work at, Lexus or Toyota and they're a car salesperson. Generally, we're going to want a 2-year history with them being commissioned, generally. We can do it with as little as 1 year with somebody being commissioned, as long as it's likely to continue. But the general rule of thumb is 2 years. Same with self-employment. The general rule of thumb is 2 years for them being self-employed. For you as real estate agents to be able to use that income, generally it's going to be 2 years of tax returns that you filed. Now, we do have options where we can, instead of using like your tax returns for qualifying, we have like portfolio products where we can use your 1099 that you get at the end of the year from, for example, like from Keller Williams or Coldwell Banker or Century 21 or whoever. Let's say you made, this is your 3rd year in the business, you made a 1099 of $200,000 from your real estate brokerage. We have programs where we can use up to 85 to 90% of that 1099 for qualification for income, as opposed to using your tax returns, because a lot of self-employed people do write a lot of their income off, so they don't have to pay as much in taxes. Part-time jobs, generally, like in order to count income, like if you have 2 jobs, generally we'll want a history of you having those 2 jobs for 2 consecutive years. For conventional financing, sometimes we can use the 2 jobs If you've had both of them for over a year and it's likely for both of them to continue, the general rule of thumb is getting it for 2 years. With bonus or overtime income, generally the rule of thumb is they want you to have received it for 2 years. However, we can sometimes get it approved if it's been between a year and 2 years if it's likely to continue. Social Security income, we can count that. VA disability income, like if both of those typically are going to be lifetime benefits. If it's Social Security coming for somebody that's retired, if it's child support, alimony, we need to make sure that that income is going to continue for 3 years after the closing date in order to be able to count it. So for example, if you have a 16-year-old child and they're only going to get you're only going to get the child support from the ex-spouse until they're 18, well, that's not 3 years, so we wouldn't be able to count that for qualification purposes. You also have pension and retirement income, and we can count the pension and retirement income as long as it's going to last for at least 3 years after the closing date. Student loans, this is kind of a big deal now, where a lot of people haven't been making payments on their student loans over the past, wow, I don't know, but 5 or 6 years since COVID. A lot of the payments have been suspended, so people aren't making payments. We, on the lending side, typically are still going to have to count an estimated payment on that. The general rule of thumb is, like for FHA financing, it's 0.5% of the loan balance. So if they have, a loan balance of $20,000, that's going to be $100 a month we're going to count for qualifying income. Or no, sorry, not qualifying income, excuse me, for the qualifying payment as a liability. If it's a conventional loan or one conventional loan type allows us to count 0.5% of the loan balance, our other conventional loan type is 1% of the loan balance. So if you're talking, you have a $10,000 student loan, that's $100 a month. A $20,000 student loan, that's $200 a month. And that's whether they're making payments on it or not. Now, some people do have what are called income-based repayment plans that they have agreed upon with the student loan provider. And if they have that and they have, like, you can see that what that monthly payment is on the credit report, then we can use that for qualifying too. But the student loan debt is, with some people is very, very high. So that's something, you need to encourage them to talk with a lender, even if they think they can afford it. They just went and got, their master's degree and they got $200,000 of student loan debt. That is going to affect them with buying a house. Seller concessions. So, somebody has to put their down payment down on a house. Unless they're doing a VA loan, it's 0% for a down payment, or a USDA loan is 0% for a down payment. A USDA loan is a rural housing loan. Rural housing being like some areas of like Valrico, some areas of Zephyr Hills, some areas of Apollo Beach. It's not going to be like Brandon or Riverview or Wesley Chapel. But that's a pretty cool product, assuming that the property would be eligible. But there are still closing costs. So I get calls from veterans, people looking for a VA loan, and they think that they don't have to pay any closing costs. I was like, well, you still have to pay closing costs, but there is no down payment. So the seller concessions, this is what the seller is allowed to pay towards the buyer's prepaids and closing costs. The seller cannot contribute down payment, but they can contribute towards their prepaids closing cost. For example, FHA, they can do up to 6% of the purchase price. Conventional, if they're doing less than 10% down, it's 3% of the purchase price. 10% or more down, 6% of the purchase price. It will not be the norm that you're going to be asking for 6% of the purchase price. If somebody's looking for like a $400,000 price house, $500,000 price house, you're not going to be asking for, $24,000 towards their closing costs or prepaids, and most sellers aren't going to accept that offer. But the lender needs to be communicating with you, hey, listen, this buyer has enough for their down payment, but you're going to need to find a seller that's willing to pay $5,000 towards their prepaids closing costs, $10,000 towards their prepaids closing costs. And before you're putting an offer in on a home, get the lender the property address, the purchase price, so they can run the numbers to make sure everything works before you get an accepted contract, and then you find out, oh, the buyer did need for the seller to contribute towards their closing cost.
I have a question.
Yes.
But the concession here, because in New York, I don't know if it's different here because you say the seller has to contribute, has to be money or give it credit, because in New York it's not like that. Like it's like okay, you asking for seller concession. The house is valued by the appraiser. Example, 500,000, right? And the person submit an offer for 480, right?
Okay.
What happened is the sometimes the seller concession can be the 4% of the value of the house, right? But what happened is if that concession overpass the 500, cannot be done. And also the what happened is the seller allow that the house be valued, how I explain it. So in other words, it's not coming from the seller. What happened is the buyer is the one paying. What happened is that seller concession, that money that he asking for the seller is putting his mortgage, right? That's the way it is here.
Well, I mean, it depends how you look at it. So, if you didn't ask for that seller paid closing cost of $10,000, in theory, you could get the house for $10,000 less from the seller. So, in essence, you're building it into the purchase price. Yes, in essence. However,
Okay.
the
Okay.
sell
So similar to over there.
yeah,
Okay.
however, the seller is covering it. Now, if you asked, I have had agents that asked for 6% of the purchase price towards the prepaid closing cost, and let's just say that came out to $20,000 and the prepaids and closing costs are only $15,000, well, then there's 5,000 left over that can't be used. So you want to make sure you're communicating with the lender. Now, the buyer could buy down his interest rate to use up all those seller concessions, but you don't want to just, I've had agents over the years that they just always put 6% of the purchase price. I was like, whoa, whoa, whoa. You don't, you, like you may not get the offer accepted by just throwing that in there. So like let's put a realistic amount in there. Seller to contribute 5,000 towards the buyer's prepaid closing costs, $10,000 towards the buyer's prepaid closing costs. But if you got multiple offers coming in on that house,
Yeah.
I'm going to be covering with the client, hey, is there a way for you to do this without asking for the seller to pay towards your closing cost? Could you get a gift from mom or dad or grandma or grandpa? Do you have a 401k account that you could take a loan out against?
Okay.
Um, you know, I'll brain with them to try to have other solutions because the more competitive the market gets, the less like chance there is to get the seller to contribute towards the prepaid closing costs. The less chance there is to be able to negotiate, for your contract prices. The less chance there is, for you to have a seller agree to, if you had a buyer that was going to be making it contingent upon the sale of their home happening on or before closing on the home they're buying. Now you have opportunities to do that where it's not quite as competitive. So that's a great advantage for your clients right now with the way the market is. Interest rates are higher than what they were 6 years ago. However, interest rates are lower than what they were in the 90s. Right now we're looking interest rates between, 6, 7% on conventional loans. They were a little bit lower than that, 60 to 90 days ago. But you're still historically like low interest rates, just not as low as they were, 5, 6 years ago. Different products that we have, we've covered, a decent amount of this already. Conventional financing, which is known as Fannie Mae and Freddie Mac. That's for primary residence, vacation home, investment properties. FHA, we covered that, primary residence only. There are specialty loan products called like portfolio loans. Jumbo loans, that's going to be your higher price point. That's on any loans over $833,000. Loan amounts over that. We have like here at our company, we have actually really competitive jumbo financing. So if you have any higher end clients, definitely connect us with them. Debt service coverage ratio. You may hear of a DSCR loan. Basically, what that is, it's an investor no income document loan. Works out great for you have clients that don't claim a lot of income on their tax returns, but want to buy an investment property. As long as they can put 20% or more down, awesome product. Very competitive rates with conventional, as long as they can do 20% or more down. Bank statement loan programs. That's going to be for a self-employed client. That client is going to be somebody that writes off a lot of their income on their tax returns. We can get their last 12 business bank statements add up all the deposits, divide it by 12 to get how much they're depositing on average per month, and then we take 50% of that. And that's our qualifying income. So if they deposit $20,000 into that business bank account per month, that $10,000 per month we can use for income. Very sweet program. They have to put a minimum down payment of 10% or more on that product. Ideally, I try to encourage everybody on that product, if they can do 15% down or 20% down, the interest rate pricing is better than doing just 10% down. Here we're a direct lender ourselves, like for the FHA, VA, conventional USDA loans. We do what are called the portfolio loans. They're also called non-QM or non-qualified mortgages. We do those in-house, and like our company also, we have broker outlets too, where just different little nuances for the portfolio products. For clients, we have foreign national borrower loans for people that don't live here in the US. We have no income document loans where somebody that's buying a primary residence they just got divorced, they don't have a job, but they have a lot of money down and they have great credit. We have options for them. Shows on here like your maximum loan amounts. Again, you don't need to remember all of this, and I'll give this to everybody. But like on a conventional loan, the maximum loan amounts just over $832,000. If they're doing a 2-unit property, their conventional loan amount can actually go up to over $1 million. A 3-unit over $1.2 million, 4-unit over $1.6 million. And like if they're buying a multifamily and it's a primary residence, they could still do an FHA loan with 3.5% down. And they just need to live in one of them, or do a VA loan with 100% financing. And they just need to live in one of the units for 1 year. And then they could turn around and rent out the other 3 units. We can use the rent that comes in from the other units to assist with qualifying. I had talked to you about like DTI or debt to income ratio. So that's something that's important with the buyer's financing approval, that we need to make sure that the house payment is not going to be too high in comparison with their income. We don't have any minimum credit score requirements as long as we have what's called a computer generated underwriting approval. That doesn't mean that any credit score, we get a computer generated underwriting approval, but we don't have a minimum credit score requirement per se. Any questions on the last few slides?
No, thank you.
A definition of a first-time home buyer. That's a good one. First-time home buyer is anyone who has not owned a home within the last 3 years. Anyone that has not owned a home within the last 3 years is a definition of a first-time home buyer. We already covered this. FHA and VA loans are for primary residences only. Somebody can have, like if they're a veteran and they have an outstanding VA loan on the home they live in, they can get another VA loan without selling that home. So some people don't think you can have more than one VA loan. You can.
Let me ask about that. Okay. The house that we buy with my son, right? He never used his VA loan. If he want to buy a new house, he can do it because we are the one that made the payment mostly,
Yeah,
So we're not
yeah.
problem.
That would not be a problem. So like he can, a VA loan or FHA loan does not require somebody to be a first-time home buyer. A conventional loan does not require somebody to be a first-time home buyer. The only requirement for them to be a first-time home buyer for conventional is if they only want to put 3% down for the down payment. If they're putting 5% down, they don't, or more, they don't need to be a first-time home buyer. For a VA loan, you can it's for a primary residence. The first time you use it, you'll have a funding fee, which is financed into the loan amount. Now, if they have a service-connected disability that they get from the VA, then there's no funding fee. But the funding fee, it's financed in if they do have one. Now, the second VA home that they would buy, the funding fee would be higher if they're trying to do it with zero down again, but they can do it again.
No, he didn't use the loan. We didn't use his VA at all.
Okay.
in the first
Yeah,
one.
then you're good to go. As long as the next house he's going to buy is going to be his primary residence, he can do a VA loan on it.
Yeah, he gonna be in just just in case he got married. He's not gonna have a problem with that.
No, not at all. No.
Oh, okay. All right. Thank you. I will let him.
You do want to be careful, like, for like if somebody's doing a conventional loan, they can put anybody on the deed with them as an owner. But like, if let's just say you have a conventional loan on your home that you live in and you put your son on the deed, that would, and he lives there, that would prevent him from being a first-time home buyer if he wanted to do one of the down payment assistance programs, like in the future. For the down payment assistance, he can't have owned a home as a primary residence in the last 3 years, and that includes if he was on the deed to the home.
Okay. This was conventional loan. This one that we buy.
Okay. And is he on the deed to the home?
Yes.
Okay, so he can do a VA loan, no problem. It's just if he was trying to do like a conventional loan and get down payment assistance, he would not be able to do that. But that's not that big of a deal. Like the down payment assistance programs, nothing is free. Generally on the down payment assistance programs, the interest rates are going to be higher. The closing costs, depending on the program, may be higher. So VA
Uh,
is, in my opinion, the best program
no,
out there.
no. He planning to use VA this time for him. His
Yeah, yeah, it's great because there's no monthly mortgage insurance.
I recommend to
100%.
him that put down payment anyway. Even if it's zero down payment, I say, you know what? They have a service to charge like a PMI. They don't call it PMI, but they call it some kind of service.
Funding fee.
It's a
Yep.
fee. It's a fee. So you don't want that fee on the market. So no, I just want to make sure that it's not gonna be
Yeah.
a problem that if he got married to purchase a home and you
Yeah.
know.
It will not. And that's a good point you bring up. Yeah, somebody does have to pay the funding fee on a VA loan. If they put a 5% down payment down, that funding fee gets reduced. If they put 10% down, it gets reduced even more.
Yeah, okay.
Yeah, you all don't need to know all this, but I'm just telling you the gist of it.
Mm.
FHA, we already covered this, what the minimum credit score requirements are for FHA. FHA mortgage insurance premium is very affordable. The credit score, again, ideally, is a 580 credit score or higher. Here are the maximum loan amounts for FHA. So if somebody's buying an $800,000 house and they only want to do 5% down, well, you're not going to be doing an FHA loan on that because the max loan amount for FHA is 541,000. FHA and VA loans are more flexible as far as the debt to income ratio. It allows it to go up to a higher threshold than conventional loans do. So keep that in mind. Appraisal condition guidelines. A lot of listing agents have misconceptions, like when you're coming in with a VA, a buyer doing like a VA loan or an FHA loan, the appraisal guidelines are a little stricter, like on FHA than conventional, but it is not that much different. Okay. So, when you're putting an offer in, like if it says cash or conventional, that's going to raise your antennas up. Hey, why are you asking that? You can ask the listing agent, why are you asking that? They may say, oh, well, the roof is, only has like 2 years left of life expectancy. That would be okay for FHA and VA, and if it's okay for convention. So, working with a lender that can help you out with getting the offers accepted is ideal. Requirements for qualified down payment assistance. Down payment assistance program from the state of Florida. The general program is $10,000 from the state of Florida. There is a Hometown Heroes program, which is awesome, but that's going to be for specific professions. Your people in the medical, we have to work full time for a Florida-based company, and it also has to be specific professions in the medical field, military, veteran, education. So like an RN, first responder, police officer, firefighter. In those professions and working for a full-time Florida-based company. The Hometown Heroes program generally has a little bit better interest rate than the regular Florida Housing Down Payment Assistance Program. It also gives a larger amount of down payment assistance. Instead of the $10,000 from the state of Florida, here they can get up to 5% of the loan amount. That program, the funds replenish, I think, between mid-July and mid-August of this year. it got used up as of about like a month and a half ago. There is some fallout funds though. I was able to get my one client fallout funds yesterday, and the buyer was super pumped. VA loans, we already covered that, like with 500 credit scores. There's no maximum loan amount for VA. If they have a service-connected disability, then there's no funding fee. That's pretty great feature of it, and it has no monthly mortgage insurance. And typically, FHA and VA loans are going to have lower interest rates than conventional financing. Here it shows a breakdown of conventional FHA, VA, USDA. Did anybody have any questions on the last few slides? Okay, so this is a nice little chart, just shows what the minimum down payments are, what it can be used for, a primary residence. Talks about like how the PMI works. Are gift funds allowed? Gift funds are allowed on any program, with the exception of if somebody is doing a conventional loan and buying an investment property, then no gift funds are allowed. But with gift funds, it gets a little tricky. You don't, you want to, if you're talking with your clients, they don't want to have mom and dad just transfer 10 grand into their bank account or just throw $10,000 cash into their bank account. We have to be able to paper trail everything. So usually the simplest way for a parent or relative to give gift funds to a buyer is for them to wire it directly to the title company, the parent to wire it directly to the title company. That saves a lot of steps and hoops that they have to jump through. Jumbo loans, we covered this. This is on your higher loan amounts, anything over $832,750. This limit changes once a year. We'll have that program's like with higher loan amounts, stricter credit score requirements, debt to income ratio requirements. They'll want reserves. Reserves is money left over after they're bringing the cash into closing. The DSCR loans, that's the investor no income document loan. Literally no tax returns are required, no W-2s, no pay stubs. The only thing we need is their assets to cover their down payment. And when the appraisal's done on the property, the appraiser will fill out a rent schedule, and that's what the projected rent is on that property for what they can have rent coming in. And as long as that rent payment equal or exceeds what their mortgage payment's going to be, you're good to go. If the rent payment is under what the mortgage payment's going to be, then a larger down payment may be required then. But this is a super popular one now. Even for anybody you know that owns properties free and clear that are rental properties, we're doing a bunch of cash out refinances, and people are pulling the cash out of properties that they own free and clear, investment properties, and they're using that to buy other rental properties. So these things are important for you just to kind of have an idea about, so you can help generate, more business and help your clients, brainstorm. Bank statement loan program, we already covered that on how that works. That's for your self-employed clients that are gonna, where we're going to collect 12 to 24 months of their personal or business bank statements and average the deposits over that period of time to use that for income. This compares like an investor no income document loan to a bank statement loan program, shows you what the down payment requirements are. Again, I'm going to email this out to everybody. 1099 loans, we covered that. That's for somebody like yourself, a real estate agent, where we can use your 1099 that you get at the end of the year from your brokerage instead of your tax returns for qualifying. And these are our specialty loan products. It used to be that like our traditional conventional FHA, VA loans, we were doing historically speaking, like from 2008 to 2022, probably 95% of my loans that I did were conventional FHA, VA loans. Now it's probably 70% of my loans are conventional FHA and VA loans, and the other 30% are these specialty loan products. Bridge loans, blanket loans. These are great for your sellers that are buying before they sell a house. So if they need to use the equity out of the house that they live in combination with the house that they're buying, this works out great. I've done some of these loans where the client got money back, didn't bring any money into closing, they own their house free and clear that they live in, or they have enough equity in it that we had them be able to get nothing brought to closing, getting back 40, 50 grand at closing, paying off credit card debt, giving them moving expenses. And then once their house sells, they can either A, pay this bridge loan off, or B, they can do a principal reduction payment where they recalculate the principal and interest after you put, the funds from the sale of the house down on it. Pretty sweet product. We have programs where they, were out of bankruptcy recently, as long as they have a high down payment, can potentially do that. The general rule of thumb is somebody out of bankruptcy, we'd want it to be over 2 years ago for an FHA loan or a VA loan. If it's like a Chapter 7 where they wipe the slate completely clean. However, if they're doing like a Chapter 13 bankruptcy, we can actually do it after they've made 12 months worth of payments. So it doesn't absolutely exclude them. We have fix and flip, which are like buy a house, fix it, flip it, renovate it and sell it. We have renovation loans where you can renovate the house and you can keep it or sell it. We have I-10 products for somebody that doesn't have a valid Social Security number, but they have an I-10. We have construction perm loans where they can build a house. We have second mortgages, home equity lines, reverse mortgages. I got one of those going right now for a lady that she's going to do she's doing a reverse mortgage. She's going to get like $400,000 cash out of her house, and she doesn't have any monthly payment for the rest of her life. There's a lot of misconceptions about reverse mortgages, but they can be pretty awesome. You can do them to purchase a house too and never have a house payment. Interest rates, we covered that in the beginning. Like, interest rates, change all day, every day, all day long. But what like your 6.5% interest rate, that doesn't necessarily like change from one day to the next, but the closing cost for that particular interest rate is what changes from one day to the next. Kind of like Bitcoin or your Netflix stock or whatever, your Amazon stock, Apple stock, like you have different investments. So the price of those goes up and down all the time. And we've seen some increase in interest rates of late due to the gas prices going up, due to what's going on overseas. So like those things change. I always recommend when the client goes under contract that we get their interest rate locked in, because if you have interest rates that change by 0.5%, over a week time period or 2 week time period, and that has happened, this year, that happened once. Last year, it happened once. Year before that, it happened once. Year before that, it happened once. And like that could disqualify somebody from buying a house if their rate went up. So having a lender that can lock those rates in, once they go under contract is ideal. Once they're under contract, make sure like, you're getting a copy of the contract to the lender. I've had agents that have forgot to send me the purchase contract, and then it's 2 weeks late, 2 weeks into the transaction, and they're past their home inspection contingency, their financing contingency just passed, and I just get the purchase contract and nobody told me. So make sure to get a copy of the purchase contract over to the buyer's lender. You're going to want to communicate with the buyer's lender once the home inspection's done, because that is typically when we'll order the appraisal. You'll want to you don't want to get the home inspection over to the lender, but you'll typically want to have, depending on the age of the house, if it's over 20 years old, you'll want to get a 4-point wind mitigation inspection done to help out with getting homeowners insurance quotes and their homeowners insurance bound. Once you get us the contract, we'll send the initial disclosures out to the client to sign. We'll lock their rate. Then we'll make sure we got all their updated income documents, asset documents. We'll turn it into our processing department. They'll double check things, and then they'll put it in line to get the underwriter to sign off on the file. Underwriting's generally going to ask for some things that we may have missed, or like things that we turn in, something on a pay stub that they have a question about, or on a bank statement. Then, generally we're ready to close our loans from when we get the contracts, generally in about probably like 3 weeks. The appraisals take about a week to get back, roughly. We have a holiday coming up now, so it might take 10 days to get those back. And then once all underwriting conditions are signed off on, we issue a clear to close. And then the closing day is when the client signs documents. Any questions on any of that process? What can delay closing? I have agents that forget to tell me to order the appraisal. Like, hey, their home inspection was done, they're signed off on, because generally we're not ordering the appraisal till you tell us to. Um, but like, if I've come to you, I said, hey, by the way, can I order the appraisal yet? No, we haven't done the home inspection. I come back to you, hey, can we order the appraisal yet? The home inspection got delayed a couple days. Hey, can I order the appraisal yet? Oh no, we're going back and forth. We're trying to negotiate some repairs on the home inspection. And if I've followed up a few times, like you need to make sure to get back with me because generally we don't want to order that appraisal until you negotiated everything with the repairs. Um, so that's a lot of times what my buyer's agents, they want to wait till they negotiated everything with the repairs with the listing side and seller side of things until they get that handled. What can delay a closing? Title issues. Make sure you get the title company a copy of the purchase contract. If the buyer is going to be want to close early, make sure you're communicating that with the title company. If your buyer is going to be out of town on the day of closing, communicate that with the title company. If one spouse is going to be at the closing and the other spouse isn't, communicate that to the title company. We may need to get a power of attorney signed for the one, the buyer to sign on behalf of the other buyer. Property survey issues. So the survey typically is ordered by the title company, but they'll typically wait to order that until after the loan's approved, the home inspection's done, the appraisal's approved, and then they'll do the survey prior to the closing. So you want to make sure you're telling the title company after all those things are done to order the survey. Now, if you're working with a trusted lender like us, that we're primarily, we do a lot of purchase loans, we're going to help you through all that process to make it easier. We're here to be a resource to you. And even if we're not the lender on a transaction, don't hesitate to reach out to me. I've helped other lenders get deals closed in the past. I'm not saying that that's my goal. My goal is to close more loans, but like we're here to be a resource to you, whether we're on that specific transaction or not. If somebody already has a pre-approval letter, I would always encourage them to still talk with your trusted lender. Because you may have like an online lender that just shotguns a pre-approval letter out and they can't get the deal done. And then you're stuck and the buyer's earnest money may be in jeopardy. They spent money on home inspection appraisal and they can't get the deal done. We come in time and pick up the pieces where another lender couldn't get it done. They didn't do a good job on the pre-approval up front. But there's also times where they got pre-approved. They can't get it done with that lender. They call me. They're like, hey, can you get this done? I'm like, no, there's no way. This guy isn't even close to being able to qualify for this home. And then they may be out their earnest money. So make sure that you're paying attention to the home inspection contingency date, the financing contingency date. You want to make sure that the buyer's lender, everything is golden and good to go, and the appraisal's done and back before that financing contingency expires. Because if not, that buyer's earnest money is in jeopardy and there's a good chance they're not going to get it back. Making sure like they get their homeowners insurance bound. We'll get a quote from a local homeowners insurance company that shops it around for the client. We'll give that to the client. They're not forced to use them, but that at least gives them something to reference. And I always ask the local insurance agent to put the necessary inspections that are going to be required, 4-point inspection, wind mitigation inspection. They'll put that in that email, and then that just helps you all know like what you need to, what inspections you need to order. Always double check with the lender. Like if the home's on a well and septic, if it's an FHA loan, we have to have a well water test. I have a third party that does well water tests, by the way. If you're doing a manufactured home, if it's an FHA loan, they have to have a mobile home foundation inspection. We have a company that we know that we can recommend you to give that to the client. HOA, if there's an HOA, some HOAs require the buyer to get pre-approved by that HOA. They may do a background check. They may do a credit check. So sometimes that takes them going down to meet them in person. Sometimes that takes 2 or 3 weeks. Like if they're buying a condo, it may take longer. So make sure that you're finding out if there's any approval process with the HOA. I would take contract writing classes at Star. If there's any purchase contract writing classes, I had went through a purchase contract writing class probably 10 times in my 23 years because like not every real estate agent's created equal. And then so I can help out like, hey, by the way, if you miss something on a contract, I'm not like a real estate agent, but I can at least say, hey, by the way, I noticed this on here. Like one common one is a real estate agent will put seller to contribute 6% towards buyer's prepaid closing cost. you need to put in there buyer to contribute 6% of the purchase price towards the buyer's prepaid closing cost. I would always recommend using like a flat dollar amount, seller to contribute $6,000 towards buyer's prepaid closing costs. And you always want to put towards buyer's prepaids and closing cost, because if you put, whatever, seller to contribute 10,000 towards the buyer's closing cost, and the closing costs are only $6,000 and the prepaids are another $4,000, well, then you're only going to get the 6,000 if the closing costs aren't high enough. So always get in the habit of doing seller to contribute X amount towards buyers' prepaids and closing costs. If properties are under construction, repairs, remodeling, you need to communicate that with the lender. Like, if they're redoing something on their kitchen, they're replacing the roof. If there's something unique, like, that there was no permits done and like they put a whole entire addition on the back of the house. Communicate that with the lender so we can help you all navigate through those challenges. If the buyer is like under contract and they're buying a house with like the adjoining lot next door that the seller also owns, communicate that with the lender. If they're buying a house that's furnished, communicate that with the lender and let him help you navigate how to word that on the contract, or maybe not word that on the contract. So just communicate with the lender before you're doing anything outside the scope. And then how to keep your loan on track, with your clients, making sure they're getting all their income documents into us. When like you're going to have your buyers that are going to reach out to you, say, oh, the lender's asking me for this, the lender's asking me for that. We're not asking them for things that we don't need. And like buyers are like, oh, I already gave that to you. Well, yes, you gave us the bank statement, but you blacked out the account number. Or you gave us the bank statement, but you're missing page 5 of 6 and 6 of 6. Or you gave us the pay stub and or W-2 and the top half of it's cut off and we can't even see whose W-2 it is. So making good copies of everything. We have secure portals where they can upload them. But we're a team. So like, if they're complaining to you about anything, let us know. If the client's saying they're going to switch jobs during the process, check with the lender first. If the client's saying, hey, they're getting a down payment from their parents, check with the lender first. If the buyer, I don't know, just got married, make sure they're not depositing 10 grand cash into their bank account. Get with the lender first on how to navigate those things. If they're saying they're going to buy a car, hold off. Don't buy a car yet. Talk with the lender first. Any questions on any of that info? Gift funds, we already covered this. Typically, the easiest way is to wire it directly to the title company. Tax implications on gifts. So like people ask, like, is there any like tax on gift? You want to consult like a tax professional. We, like as a lender, aren't like reporting things like to the IRS. We don't have forms that like we send to the IRS, like how you're handling a gift, like coming from a parent. That's something that you can just check with their tax professional on, because a certain amount of gifts aren't going to be taxable. We're going to send weekly marketing pieces out to you all that we can brand with your information on them. So you'll get these every week, and they're just different reference materials, different loan products, like if down payment assistance is available at that time, when hurricane season's coming up. But you can get those things branded to you and you can share that with your database. We will do classes like this periodically. We can do another one upcoming here on our down payment assistance programs. We can do another one on our portfolio programs. We can do one on renovation programs, like your rehab loans. And you all can let us know if there's classes that you're interested in us doing. We've done tons of them over the years. Here's our contact info. This is my office line. I do not get text messages to this office line. My cell phone, I do get text messages. Generally, I just give my cell phone number out to everybody, clients, and they can text, call. As far as like referring us somebody, like give them our information and give us their information. So then we can help you follow up. And again, it's a team effort. You guys got a lot that you're learning and you're doing up front. So let us know how we can be a resource to you. And anybody got anything before we wrap up here? Oh, we do a Friday call every Friday from 9 to 9:30. If you're interested on being on, we send a text message reminder out. So if you're interested in being on that list, if you want to shoot me a text message to my cell phone number, or you can email me at smiller@vandykmortgage.com. VanDyk, there is no E at the end of VanDyk. So it's not like the Van Dyke Road in Lutz. So it's email address is right on there, smiller@vandykmortgage.com. It looks like vandykmortgage.com. You can email me and we can get you on the Friday call list. And basically, we have a homeowners insurance company that talks from 9 to 9:30 the first Friday of every month, a title company that talks, I believe it's the third Friday of every month. We'll typically talk with mortgage updates the second Friday of every month. And then we'll typically have like a home inspector on, I believe the fourth Friday of every month. And then we'll have guest speakers like an appraiser or a financial advisor. But it's a great half-hour call where they'll talk about like what's going on in the flood insurance market, the homeowners insurance market, the condo market, things coming up on title fees, like fraud cases, closing under an LLC, power of attorneys, ladybird deeds, like tons of stuff that I'm not an expert in title. I try to learn as much as I can. I'm not an expert in insurance. I try to learn as much as I can. But we do that every Friday. So if you want to get on the text message reminder, and it just has a Zoom link in there, you can text me at 813-383-6066, or email, say you want to get on that list, and we can add you on there. And thank you everyone for joining. Appreciate it. And then we'll send text message reminders again for upcoming classes if you guys like to join. And again, don't hesitate to reach out. Like, you can reach out over the weekends. We're working when you're working. I have options where somebody can do online applications. They can, I do quite a few of just my appointments over the phone, and I'll just take their information all over the phone. We can meet in person as well too. My office is in Tampa. Awesome. Well, yeah, again, thank you for everybody joining us.
Shawn.
Appreciate it. Awesome.